Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, October 1, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So it was an interesting day today. I'm going to classify today, for the most part, as a gap and crap. Now, the market didn't finish near the lows. That would have been really negative for the markets. But we're going to take a look around the block, and I'm going to show you all the different things I'm looking at. Once again, we're going into a dangerous place right inside my mind. I'm going to show you everything I'm thinking and looking at, what I'm seeing in the markets, and then we'll go from there. Let me just recap what positions I've got going right now, because there wasn't a video on Friday nor over the weekend, and I know a lot of you like to have those. I apologize. I'll try and do more of those. Sometimes I just need a break. That's all it is. Anyway, so in terms of positions, I lightened up the short positions at the end of the week last week, and I kept a little bit on, not too much, okay? And then I ended up putting more on today as we began to see the markets kind of have an intraday reversal. And we'll take a look at some intraday charts, and I'll show you what I was looking at. So I do have some more shorts on. I have some shorts in the Qs, and I have some shorts in the puts. And when I play the indexes, I generally do them with either exchange-traded funds or the leveraged exchange-traded products, or I do them with options contracts, so I know what my risk is. I have a complete limitation of what my total exposure is to the downside, meaning if the market were to go opposite me, against me, I know what my total exposure is with the options. So I like to play the indexes that way most of the time. So we do have a lot to go over. Before we do, let me pause here and make mention that I really do appreciate everybody's participation in posting comments under the videos. Please continue to do that. I love the thoughts. I love the interaction. It's helpful to the entire community. So I thank those that continue to participate. Please continue. Those that haven't participated, please consider doing so. In addition, hit the like button under the video and share the video with those people you think can benefit from this information. So we're back to the daily chart, and I'm going to do things a little bit different tonight than we normally run through. And as we're doing it, you'll understand why. I want to get a visual. I want to get a visual perspective, or I want you to get a visual perspective of the daily chart of the indexes, and then I want to go to the daily charts of some important equities or some important stocks out there that are the names we know, the widely held names, the ones the mutual funds hold, the pension funds, the hedge funds, the one that we all own in one way, shape, or form in some manner, one way or another. And I want to look at the daily chart of those as well, and we'll make some comparisons, because I think right now, right here, the market is at an important juncture. So first, let's run through some daily charts. So we see the daily chart of the SPDR. Now remember, it wasn't that long ago that the SPDR paid a dividend. So while we're on that topic, let's just take a look at the cash index and make sure we understand where we are. Now, before we do that, on the SPDR, here's where we are, right? So let me move this over and let's understand where we are. So here's a breakdown candle, and the high is 293.22. The high today was 292.93. Now, if you add back in the dividend, there's a high probability that we pierce through there, spike through on an intraday basis, but still would have closed below that important level. When you look at the cash index, you can see right here that the cash index almost got to the old highs. So if we move this over, you see the old highs were at 2940.91, and the high today was 2937.06. Made an attempt for the old highs and closed down. Not closing down at the lows, but closing down well off the highs. So that's one of the reasons why I say the market is right now at a very critical juncture. So there's your daily chart of the S&P and the SPDR chart. So let's take a look at the Qs real quick. So the Qs, again, we made an attempt at the old highs. Now the old highs at the Qs were 187.52. Today's high, let me move this over. Today's high was 187.53. Does anybody out there think that that's an accident or a coincidence? Of course not. 1 penny spiked through the old high, and then we finished underneath that level. Not necessarily on the lows, but you can see that we finished below what I consider an important level. Let's talk about that for a second in the Qs. So I have the line, the horizontal trend line, at 186.40. The reason why I consider that an important level, let me show it to you. Here's the high, okay? The open of that day was 186.41, and the close was 186.41. So I think that's important. If the market made a high on that particular day, opened at a certain number, and closed at a certain number, which was 186.41, I'm saying that that number, 186.41, 186.40, I'm saying that that number is important, and I want to know when the market closes below that particular price level. Now, here's the make it or break it, and this goes for across the markets, for all the markets. So where does the Qs get bullish again? I'm saying the Qs are bearish right now based on the fact that we made an attempt to break out. We see a potential failure in the making, right? We don't really have confirmation that a failure took place. This is 1 day attempt at old highs. We did not close above the old highs today. We closed below what I consider an important number. But again, it's still 1 day. So we're above all the moving averages. We know the market, in this case the Qs, are still in an uptrend. So we have to be cognizant of both sides of the equation, the bull and the bear case. From a very short-term perspective, I consider today's activity a reversal. Why is that? Well, here's the hourly chart. Look what happened. So we gapped up, and then we couldn't hold it, and we came down to fill the gap by the end of the day. Now, maybe that's all we did. Maybe all we did was fill the gap and we go higher again tomorrow. That's certainly possible. And if we close above today's high, and let me go back to the daily, and I'm sorry to jump around, but you can pause and restart the video and watch it as many times as you want. This is important information, so if you're not following it the first time along, you can replay it a couple of times. But here's what's important. If we close above today's high, right, which would be above an all-time high, if we close above today's high, then it's bullish. I have to cover the short position, and we'll find another spot at some point down the road, but I don't want to be there with another potential vacuum to the upside, because a close above today's high would have that potential. Obviously, it could be a fake out, but I don't want to be there to find out. I will reshort if necessary with confirmation, but a close above today's high, I will have to cover the position. That's my stance today. I may make a different decision in real time. I don't think so, but I'm just letting you know my mindset right now. Keeping with the concept of looking at the daily charts first across the board, the IWM really did get taken out behind the woodshed by the end of the day today, down about 1.33%. So it did have an ugly day at the end. And what's interesting is, it is, as you know, and you know this, I say it every single day, and I say it every single day for a reason. It's my favorite market leading indicator. Why is that? Let's deviate from the daily chart for a second, and I'm going to show you why it's my favorite market leading indicator. Look at this daily chart, okay? Here's the start of today. This is the first candle of the day. You see the gap and crap. We opened up, okay? The opening print of the day is 169.31. That's all the way up here at the high of the day. And we immediately crapped out. That's a negative sign right out of the chute. And then you see how we're perpetually down all day long. Look at the spider. That's not the same chart. So the spider was going sideways, found some support at the opening range low, went sideways again, and then broke down. The triple Qs on the intraday 10-minute chart. Very similar to the spider, but when you look at the IWM, now you understand once again why this is my favorite market leading indicator. I could have told you dollars to donuts with about 80% accuracy, 8 out of 10 times, based on what I was seeing with the IWM, that the other markets would eventually roll over. Let's put that together with what I said before. I'm going back to the daily chart for a second, because I want you to remember what I said before. I put back on some more short positions. Why did I do that? based on what I was seeing in the IWM. Could I be wrong? Of course I could be wrong, but I do with what I think I'm seeing based on what my experience is telling me, based on what each individual market is telling me, and based on what I think is the likely scenario going forward. I thought the IWM was rolling over. I thought the other markets would follow. We're at highs in the market, so I know where my risk is. I'm still very close to risk. I may have to take a loss if I'm wrong, but how close am I to risk? I'm very close to risk. So even if I do have to take a loss, I have two things going for me. A, I have a very defined loss because I have an option position, so I cannot lose more than the total position that I put in the puts themselves, right? That's number one. And I'm very close to risk. If we close above today's high, I'm out, and there's no way that these puts would expire worthless to begin with. I think it was a good risk-reward type of trade. Now, before we move on, I just want to make sure that we're all aware of something that's important. Again, the volume was on par with about average volume. So we can't really say that that's low volume, it's not high volume, it's just average. We just take it at face value. Okay? We're above all the moving averages in the spider. So while I have a short position in the Qs and the spider, I've taken off the short position for the time being in the IWM with that thrashing today, what I had remaining left over. But we just have to be cognizant of the fact that above all the moving averages, we're still in an uptrend. We could turn around tomorrow, wake up to another gap higher, and the market could be gap and go and have a trend day higher. That's certainly possible. We just have to be aware of both sides of the equation. If that happens and we begin closing hourly above today's high, there's a likelihood that I would cover the positions and just come back to assess it later on. I can always put them back on if confirmation emerges that it was another fake out. Remember, the market's job is to trick, trap, fool as many traders and investors as possible as much of the time as it can. We've been looking recently at the VIX, and when you look at the VIX, you see here that we're again below all the moving averages. That's a negative. We're still staying above an important level, right? I believe, what was the low here? The low is 1159. We closed at 1179. We're still technically above this level. Is still, quote unquote, okay for the VIX. Not great, not terrible. I wouldn't necessarily load up on a long position here, but certainly we're again closer to risk on putting a long position on the VIX also. So risk being somewhere in that 10 neighborhood, 11. If it broke 10, I would certainly buy the VIX on the long side. But, you never know exactly how far down it can or will go. But anytime we get below this 12 into the 11s neighborhood, you know that it's getting close to or close enough to risk where we begin getting interested in the VIX. Let's take a look at the transports. What do we have working in the transports? And by the way, after the transports, we're going to go back to take a look at a couple of other charts. I meant to do it before the transports, but since I've already brought the chart up, we'll do the transports. So we're below the 20-period moving average, making what I like to call a bearish wedge pattern. You can see where we went today. We made an attempt to test the high of the breakdown candle. We didn't quite get there, but then we closed below the 20-period moving average. I have no choice but to take that in a bearish fashion. What is this chart indicating to me? It's indicating to me that it has another move to the downside. What would wipe that off the table? Very simply, if on the daily chart we closed right above the high of this breakdown candle, if that took place, it takes the bearish wedge pattern off the table. That's it. It's as simple as that. We know what we're looking at on the upside, so we know what the bull case is, we know what the bear case is, and we know where each of them is wrong. Now, I said I wanted to look at some other charts, and there's a reason why, and it goes in concert with the Qs. So let's go back to the Qs for a second, and well, even the other indexes as well. But so here's the spider. So let's just take notice of where we are. Remember, approaching the old highs. Nothing wrong with the chart. Very bullish. The question is, are we going to break out or are we going to fail? When we look at the Qs, where's my Qs? I can't even find my Q symbol, so we'll type it in manually. And the Qs, again, same routine. Approaching the old highs, we're either going to break out and there's going to be another leg to the upside, or it's going to fail here at a double top. All right, that's what the picture I wanted you to have in your mind. So now we have Amazon, same routine. We're not at double top, we're close to double top. Are we making a lower high? Bull cases, we're above all the moving averages. Bear cases, we have yet to bust through the breakdown candle high, 2040 and change, right? That was the breakdown candle high, 2040 and change. The high today, 2033, didn't even get there. So close above 2040, and that's 2040, and you're likely going past the old highs, so you wouldn't want to be short Amazon with a close above 2040. How about Apple? Where do we stand with Apple? Making an attempt to break out of the old highs. Can't quite do it. Didn't do it today. Is a failure. Are we making a double top and a failure? Or are we going to consolidate and make another attempt, or just simply make another attempt? Again, this is all the reason why I've said before earlier in this video, we're at a very important part of the market, very important critical juncture in the market. How about Facebook? This is a busted chart. Look where Facebook is. This wants to go lower. This is making a bearish pattern. This is telling me lower prices are coming. Netflix, we're not at the old highs. Technically speaking, this is a bearish pattern because I can make a case, and remember, I always like to focus on the first thing that my mind focuses on when I look at a chart. I see this down move here, and then I see a bearish wedge pattern, and likely story is we're going to see another down move. But you see this gap here, so Netflix may have its sights set on 400 to get back up to that gap. So I see a couple of things here. Daily chart is okay, we're above all the moving averages, but we're nowhere near the old highs, so that's somewhat divergent from the Qs. So that's interesting. Where do we stand with Google? Google, lower highs, right? We've already had a lower high put in. So we had a high, we had a lower high, and now we have a potential third lower high. Now, if that's the case, well, there's really already, these are the same level. So I'll count that as one. So it's 1, 2, and here's a potential third lower high. Is that going to reject the market on Google? It's interesting. You see why I'm looking at all these different stocks is because I'm looking for confirmation, non-confirmation, divergences. I'm looking for clues. Sometimes when I look at the charts, in fact, most of the time, or all the time, when I'm looking at the charts, I'm not necessarily looking for something in particular. I'm just looking, and I want my mind to tell me, I want my eyes to tell me what I'm finding. I don't want to go into a chart with a preconceived idea. Baidu, look at this. Lower highs all the way through. Now, Baidu and the next chart, Baba, there's another reason why these charts are particularly weak is because the Chinese market is particularly weak. Now, anybody that wants to hang that on the trade wars can do so. Maybe it is, maybe it's not. Doesn't really matter. But China's market been very, very weak for a very, very long time. Here's a proxy for China. Now, over the last couple of weeks, this is the Shanghai index. Over the last couple of weeks, the Shanghai index has been acting very, very nicely, but you can see here, and you can see where I was looking for support around here at one point. I didn't trade it. I was just analyzing it at the time, but here I'm looking for a lower price. You can see why. Look at the monthly chart. Doesn't this remind you of the bond market? Let me go back to the bond market, and we'll say, look at this chart in the Shanghai, and then I'll go back to the Shanghai in a second, just looking for my bond market chart. So if I find the bond market chart anytime soon, and here it is, doesn't it look very similar from a monthly chart perspective? We went back up to test a breakdown candle high, and then we fell off. And when you go back to the Shanghai, very similar activity in the Shanghai. Now here's the 100-month moving average. We seem to be finding support at the 100-month moving average. But if you play this out, this is a very, very weak chart. Until and unless you can close above the high of this breakdown candle on the monthly chart, and this could be months away, but we're likely going down to around 300 in this index. I think that puts the Shanghai somewhere around 2,600, maybe 2,500. I haven't worked out the numbers in the Shanghai. I just get this symbol in particular, so I use this as the proxy. And this isn't that important. We were talking about the stocks, and there were two stocks, Baidu and Alibaba in particular, that are extremely weak, and one of the reasons is because of the Shanghai. So you see, all these stocks are part and parcel to the Nasdaq, and that's why I wanted to show them to you, because we're at a very critical juncture in the markets. Are we going to break out to new highs, or are some of these divergences going to grip the market and we're going to see a rollover and some kind of correction for several weeks out? Here's the last equity chart we're going to look at, which is Tesla, and we're only looking at it for fun. I'm just patting myself on the back, and allow me to do that for 1 second. And I'm really only doing it for fun because I have 0 shares of Tesla leading into today. I just want to show you something that's kind of neat. So on Friday, my gap traders in the Lazy Gap Trader course had a gap level in Tesla, 263.24. So you can see what happened. We came in, and that level actually worked out on Friday. I made a video about Tesla on Friday, so you can see what happened. Tesla was getting creamed on Friday, all that news around Tesla and Elon Musk and the SEC settlement and all that stuff. So finally, later in the day, Tesla comes into 263.24, and then we had a gap up this morning on better news for Tesla, on the settlement of the SEC and all that stuff. It's not the point why. The point is what happened. And you can see here, I'll just bring up an hourly chart. Tesla opened today. The opening print was 305. We were down at 263 on Friday. Now, I played it on Friday. I traded it, but I didn't hold it over the weekend, so I didn't benefit from this wild move higher in the morning. I don't know if anybody did. Nobody notified me that they did. I'm just making a point that from a chart perspective, look what happened. Tesla comes down. It makes a bearish pattern. And this is really, the fun part's over. Let's talk about the real reason why I wanted to bring this up. Here's a down move, bearish wedge pattern. We go down. We fill a gap. This is right out of both courses, okay? And then all of a sudden, a day later, and this doesn't happen often, folks, but it does happen, a day later, we're at $310 from the gap down at 263 a day earlier. It's pretty neat stuff if you think about it, right? So just for fun, there's where Tesla is today. The chart even looks weird. Here's where we were on Friday, right down here. And here's where we here's where we opened and closed today, and we closed near the high at 310.70. Pretty slick move in Tesla. Pretty unbelievable. All right, so you know where I stand in the equity markets. It is what it is. We're at a very critical juncture. I'm watching everything closely like a hawk. Going over to the gold market. Let's deviate for a second. And you can see here that, look what happened last week. So we had this gap area, 1184.20. We've been talking about 1184.20. In fact, we've had this horizontal line in the chart. I don't even know how long. In fact, we probably have had it on since, well, I don't even know. I'm not going to guess. You can go back in the videos and figure it out if you're interested. It's been weeks, right? So we're looking for two in particular, or two important areas in gold. Number one is it had to stay on the daily chart, closing above the low of the breakup candle. Didn't do that, closed below there Thursday of last week, right? That was on the 27th. And then on Friday, we go to fill the gap. And what happens? Look at this. The gap, as far as I'm concerned, the official gap is 1184.20. That's the line we've had on there for a long time. Look where the low is. You're not going to believe this, right? The low is 1184.30. Anybody think that's an accident or a coincidence? And now we're at 1192.50 as I make this video. We've actually been obviously higher. We right off the gap, we made a high of 1198, missing the gap by 10 cents. Pretty remarkable stuff. Let's look at crude oil. Oh, by the way, so let me go back to gold for a second. Am I bullish or bearish gold? Well, on the daily chart, I'm neither. We closed below the low of the breakup candle. That's number one. We're back above it now, but it's still a negative. We filled the gap. Maybe that's really all they needed to do, but we're below all the moving averages. So there's nothing that I like on the daily chart from a long or short perspective. On the hourly chart, You can be long hourly against this pivot low down here at 1188 if you were so inclined. Looks like it wants to come down and at least test those moving averages again, maybe even that double bottom area. Probably comes back down to retest around that 1190, 1189 area. That's my best guess from an hourly chart perspective. I'll leave this line on the chart. We'll come back and see what happened when we talk about it tomorrow. But all in all, no trade for me in the gold complex right now. I just don't like the activity. Nothing that I think is a high probability. Now let's go have some fun and talk about crude oil. Look at this spike higher in crude oil. Pretty evident what happens, and now you're seeing the reason why, once again, why I talk about these price levels as being important. Look what happened once we got above and closed above the high of that breakdown candle. We took off to the upside today. We were up over 3% today. That's a rip higher. We're back into the hot zone. Check this out, folks. So we've talked about this hot zone ad nauseum. We missed it and we pulled back. And we never really fully broke down in crude oil. And here we are again, right smack in the middle of the hot zone. Let's make it simple. Where are we going? What are we doing in crude oil? So here's what I think is going on. I think there's higher to go. We're either going to stall out at 76 or 78. I don't know exactly which one. If I said I knew definitively, that would be a fool's game. I don't know. But 76 or 78, I'm going to begin building a short position until we begin closing daily above 78. That's my game plan for crude oil. Now, they may begin that activity overnight. That tends to happen in some of these commodities. So what I mean by that is you may see a spike up to, and I'll make up a number, 76 and a quarter, 76.10, whatever. You may see a spike up to a number like that in the middle of the night when nobody's looking, and then you wake up tomorrow and it's down $2.50. So I'm hoping that's not the case. I do not currently have a short position in crude oil. I'm not going to play the actual commodity futures contract itself. I would rather have some options in taking a position in shorting crude oil, hoping that we don't get one of these midnight spikes and wake up to a gap lower in the morning. Doesn't let me in. So that's my plan in crude oil. And with that, folks, I'm out of wind, and I'm going to give it a wrap here. So I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.